Hey guys, wanted to do a video on a certain setup called gap up short. These are the stocks that have been gapping up big pre-market, and what are the indications that they may sell off intraday compared to if they're going to run. Why was ABIL a runner and why was KBSF a crapper, or whatever you want to call it? Why did KBSF take a shit, and why did ABIL run? In my opinion, here's what I look for. These companies are different but similar. If you look at, let's just use like a free website like FinViz here, and we'll just go to ABIL. You can see that the market cap was roughly 13.5 million on that day, because you can say that that price was pretty close. Shares outstanding are roughly 2.6 with a 910,000 share float. Now, if you look at KBSF, an even lower market cap and an even smaller float. Now, neither of those to me are a big indicator. They're just indicators that tell me that this chart is going to have to do something very specific in order for me to feel comfortable shorting a nano float day one spike or gap per se. So because of the setups I've traded on these gap up shorts, I know what I'm looking for very closely. And so here's my actual trades here in this tool called EdgeWonk. It's what I use to track all my trades. But here's my actual performance of these setups. So I've traded 11 of these setups, and I tend to roughly go rather small size, and I have a 70% win rate. I make about this much money on each of those, but I've profited $755 from this exact setup, 5 consecutive wins, 1 consecutive loss. I only take a loss every now and again. And the things I've studied about these are not just these 11. I've tracked this pattern and watched it and pulled data from back April of last year. So I want to show you what I've learned to help me have a rule and plans in place to protect against that, or protect you from gambling per se. So I'm going to use my mouse to kind of write and draw charts here, but just bear with me. So ABIL, the difference here is, let's say this is ABIL, okay? Here's pre-market. It is a spike here, and then it consolidates, rips. Now you're at market open, okay? Here is the key, and we're going to use a 10-minute candle, okay? I'm not going to touch anything until this first 10-minute candle tells me something. And here's what it does. If the chart opens up, spikes in whichever direction, it does not matter. All that it matters is how it closes. If it closes green, and I'm going to leave it hollow for green, and it looks like this, that is a no short for me, okay? I'm not going to short that chart. Now, here's why. Because that means that the bulls are in control. Even though this gap up, so let's say that this is like prior close, and this gap's all the way to here, and let's say that this gap is, 60%, if it still can claim a green candle in 10 minutes, the bulls are in control, ladies and gentlemen, and stop trying to pick the top. Just don't. You're going to get ran over, just like everybody did trying to pick the top on ABIL, and everybody's saying that they knew it was a short. Yeah, everybody knew it was a short, but nobody knew when it was a short. It was a dice roll. when it was time to short. When it was truly a time to short, it was already too far gone, and now it's just going sideways. But the dice roll is when you're trying to pick the top or short weakness or try to pick a trend change. You know, people can say, oh, I nailed the top, I got this entry. No, you didn't. You rolled the dice and you took a gamble that this was going to play out this way. You did not statistically know that was going to happen. This is my point. 10-minute candle closes green, don't short it. Just move on, don't touch it. You can try to trade it later, but don't trade this gap up short pattern. Okay, that's not the strategy anymore. Now let's say that this one down here, let's say, here's how this one looks. And again, this is, you know, KBSF today. Here's what it looks like pre-market. It's gapped up, you know, right here. I remember when it opened, it was what, you know, like 50% up, something like that. And from the prior close, let's just say again, this is prior close down here. When it opened up, what did it do in the first 10-minute candle? And you guys can go back and look at it. It went straight down. Big red candle, okay? We're just going to color that in for detail purposes. Okay, and it had a little wick here, and then not much wick up here. And then the next candle opens here, pops, and then just continues to die from there. Okay, so now you've got, again, these are 10-minute candles, okay? So the first candle here is now a red candle, okay? So now that it's shown weakness and the close is below the open, I don't care if it looks like this and there's a giant wick up here and it's down here like this, or it's a tiny red body and a big wick up top, or a small wick up top and a small red body. It doesn't matter. Red candle, you can define two areas, okay? You can use opening price as your risk here, or you can size up here. It just depends on the chart, okay? That is your discretion. You're going to short this strength here. This will be your entry area. Again, your responsibility to size accordingly based on whichever risk level you choose, okay? And then take that size accordingly. Almost 70% of the time, the chart will do this. If the first 10-minute candle is a big red candle and the next one is where you take your entry and you risk in these areas here from either opening price or high of day, whichever you prefer, and then you size in based on a max loss of those levels. 70% of the time, the chart, remember this is prior close, is either going to go like this for the rest of the day, and the close is almost always less than or within 3% of the morning low, which is generally around 11 a.m. That's when the morning low generally is, okay? And the close is either 3% lower, equal to, or 3% higher. Now, sometimes in the cases like KBSF, it just takes a dump and now is red on the day. So those are when you have to determine what your maximum potential gain is. Me, I like to take profits around 15% gain. I take half off the table. Wow, what was that? Let's try that again. Half off. And then my remaining shares, I will look for 25% to 30%, okay, on last half. All right. Now you've got an entry plan, a risk level, a strategy nonetheless, and a way to protect yourself. Again, this is ABIL up here. Why would you not short ABIL in the morning and wait later in the day for it to give you a sign of weakness? Is because of this 10-minute candle right here that closes green, closes above its opening price. Protect yourself and know when the bulls are in control and when the bears are in control. Don't try to pick a top, ride the wave, okay? This one down here, KBSF, okay? The only difference here to me is simply momentum. ABIL, everybody wanted this to be the next AX or AWX. Next, I call them the Form 3 supernovas. Everybody wanted ABIL to be the next Form 3 supernova because it was an ultra low float and everybody thought that Mint Broker was going to swipe up all the shares. So the bulls are, it ends up going spike, consolidation, spike, consolidation, spike, consolidation, spike until the bulls finally give up and they go, fuck it, whatever. And it goes, and that right there is a sign that they're giving up. And then it'll probably bounce. And then the next day you're going to go like this. Okay? But you have to take that gamble that, you put your risk up here at the high of day, because what if after hours goes like that, like AWX did? You've always got to have a stop loss in if you walk away from the computer. If you walk away, have a hard stop to get you out, okay? So I hope this gives you guys some insight to not short charts like this. No short. And the key indicator is just sitting on your hand for the first 10 minutes of the open. Just sit on your hands and watch this 10-minute candle. Now, here's the thing with these down here. I will give you this benefit of the doubt, and you can do with it what you want. When you see it's going to close this low below the opening price, it's not a bad strategy to take a very small starter in this first candle with the gamble that it is going to close red. If it does not close red, take that starter off and move on. But you could take a starter in this candle once it looks and feels that, again, is your discretion. This is very discretionary. Once it feels very weak here in this candle and it appears that there is no way that this thing is going to come back from this, take a small starter in this. If your plan is to go 1,000 shares, take a small 200 share starter. And, you're taking 200 shares. Let's use a case here where, let's say, this price right here is 6, okay? And you're taking 200 shares at 6, and, that's, $1,200 starter. And now, once you get to a full 1,000 share position, you can enter here, and let's say that you're entering, right here, or in this area here. Let's say you don't get the top, but you at least get it into strength and you get a 550 fill, something like that. And you go 800 shares times 550. Now that, on my handy dandy calculator, always have a calculator on your desk. Don't try to use your desktop one. It's a whole lot quicker to do that. Now you've got, 4,400 here. So now you've got 4,400 plus 1,200 equals a $5,600 position. Now, rather than a 550 average, you've now got a 560 average, and you're now 10 cents better than the person taking the short down here, just simply because you took a small little test position. Now let's say you were to stop out on that 200 shares and you lost 40 cents a share because the opening price was, $6.40. God forbid you lose $80. That is not going to change your life. You can easily walk away unscathed, walking away from an $80 loss with a test position. In order to be able to gain something like this where you can watch KBSF just die, okay? Another chart of this the other day was CH KE. It ended up the same way KBSF did. However, the only differences were this. It had a similar pre-market, so on and so forth, and then when it opened, it popped, died, okay? Popped, died, pop, died, pop, died. Boom. And then tanked. But then it had this comeback late day and went like this. Or sorry, it didn't break the high day. My bad. My drawing is a little out of scale there. But it popped, died, pop, 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 pop. It really died, came back a little bit, and then broke to like here on, you know, a big volume candle right there. I don't know whether it was an alert or what. But the idea is that once it hits here, you're taking a 15% gain on half of your shares. And then what you want to do with the remaining half is you want to move your stop loss down to break even. You want to break even stop at that point, okay? On last half. Why a break-even stop? Because it's a whole lot better to walk away with a 15% gain on a half and a no gain on the other, and you're taking, you know, 7.5% overall. That's the better way to go with this. So the rule here is if first 10-minute candle is green equals no short. Okay? Red equals short. But again, always have a risk level because there's been stocks that, you know, they have a big, massive red candle and they make a comeback. And you just have to protect yourself. ABIL was one of those in the past. So I hope this helps you guys. You all have a wonderful night. I'm sorry if this is dragged out a little bit. I'll do my best to speed up the drawings. Take it easy.